Good day and welcome to the Lodging Juice Live, hosted by Cleveland Research. At this time, all participants have been placed on a listen-only mode. It is now my pleasure to turn the floor over to your host, Vince Sepiel. Sir, the floor is yours.
Good afternoon, everybody. Appreciate you joining us here today. Before we get started, there are a few important disclosures I want to read through. We have 3 participants on today's discussion, all of whom have many years of experience in the lodging industry and are long-standing relationships with Cleveland Research. We've conducted regular conversations with these individuals over the years as a way to get a read on important trends within the industry. The conversations are helpful to our research process. It's important to note that the views expressed by the participants are their own. The participants are not being paid in any capacity to participate in today's discussion. All the topics for the call have been approved by our compliance team, and the intended discussion will not contain any material non-public information. Lastly, today's call follows notes that were published Thursday, June 11th, and all the questions for today's discussion are tied to such. So, with all that out of the way, excited to be joined here today by Dan, Matt, and Evan. Thanks for being here, guys.
Great to be here.
Thanks for having us.
So, a little on the speakers for background and where the conversation's headed. First, all of our panelists have extensive backgrounds in the U.S. hotel market. Matt leads the investment team at a travel-focused private equity firm and is focused on sourcing, executing, and managing hotel investments. His portfolio is pretty evenly spread around the U.S. Evan's co-founder of a hospitality valuation and advisory firm, works with many of the largest hotel investors around the country. Dan heads up the Americas region for one of the largest hotel brokers in the world. In terms of where the conversation is headed, we'll start with real-time performance trends, look at the top and bottom line, and discuss deals, development, and lending. So to kind of kick it off here, beginning on the top line, RevPAR, it's been stronger than most people expected entering this year, up 4 to 5% here in the second quarter to date. Probably similar to that in the first half. In our revenue manager survey we had out last week, we're seeing second half outlooks pretty stable, and people expecting something around a 3-ish% growth for the year. So, just to put the questions to you guys, what happened? 2025 RevPAR growth was hard to come by, and things have clearly reaccelerated. It seems pretty broad-based. What's the best explanation for where we are here today?
I'm happy to go first. But we got to go back to the tape, Vince, because I think 6 months ago or last time I did this, we had to take some over-unders and are we optimists? And I took a heavy over with RevPAR projections. So sometimes it pays to be an optimist here.
You and Chris Nassetta were right.
That's right. I think, look, there's a lot. We agree. We're seeing the same thing. Certainly some of the singular events, World Cup, 250th, even just some of the sports events and big ones have been really helpful. Have seen some of it through ADR. But probably the brightest spot for us has been on the group side. We've seen really robust group demand, which just allows our revenue managers and commercial strategy to take hold. And then the other trend we're seeing a little bit of with kind of all the macro and geopolitical turmoil, some of those the domestic travelers leaving the country have stayed home. And actually I'm starting to see some positive trends from international travel. Again, obviously have the big events driving some of that, but even the Canadian traveler getting a little bit better. So I think it's just been a bit of a combination, and then maybe the overarching piece of that, which helps from both sides, numerator and denominator, is just the lack of new supply across our business has just really helped. So that's what we're seeing.
Matt, a little bit more there. Like, how's June tracking relative to your budget across the portfolio, and how are you feeling about July? Just what's your kind of sense for as we're moving into the third quarter?
Yeah, we're pretty bullish. June and July occupancy is a couple points up, and ADR has been maybe a touch down. Again, we think that will pick up as we kind of firm up the groups and they come in, and hopefully the World Cup is it gets moving a little bit. And so, RevPAR may be up a hair, but driven largely by occupancy rate slow a little bit. But I think that's actually going to pick up, and then that'll drive even more RevPAR growth. So it's a bit of the same trend going forward the next 60 days.
Got it. And Evan, Dan, anything to add to kind of why we are where we are, and based on your conversations with clients, how they're feeling about where things are headed for this summer?
It's Evan. Yeah, I'll jump in. Thanks, Dan and Vince. I think it's actually interesting. Obviously, everything Matt said is on par and correct. I mean, we've seen corporate transient pretty continued strength in the demand side and continued strength in the ability and desire to pay more, which has been strengthening the ADR. Lark, which is our data analytics platform, as you all know, shameless plug, obviously. Lark projected RevPAR as of the end of 25 for 2026 to be 0.6%. And within that, Ryan Melliker, my partner, had projected 1 to 2% national RevPAR growth for the year due to World Cup. So if you think about that, basically projected negative RevPAR growth in 2026. We just came out with our Q2 numbers. Ryan did his webinar last week, and we're projecting 3.4% RevPAR growth for the year, all in ADR. So flat occupancy, about 62.2, 62.3, whatever it is. This is nationally, obviously, but a 3+% growth in ADR. So the strength seems to be certainly in that the demand is willing to pay more. And that goes for leisure. Convention center pacing is up 4% over last year. Last year's convention center pacing in 25 was up 4% over the year prior. So you've got really good growth, which provides, as we all know, a really nice base and a foundation upon which you can appropriately revenue manage and kind of gear up on the ADR side. So I think that's kind of been a surprise to the upside. Personally, I did not think, just a gut level, that World Cup would be super strong. And thus far, I think to Matt's point, it hasn't been. Do the later rounds get better? Probably, but that'll be only incremental for those few cities that really benefit from it, and it'll be for a short period of time. I actually think I was in Miami this past week, and FIFA, Miami, very Latin in terms of culture, a lot of the Latin countries playing nearby, every television, every bar, every restaurant, every hotel, but the hotels were empty on the beach. The hotels were empty overall. A lot of the typical, even though it's down season, a lot of the typical travelers weren't coming in out of the fear for the World Cup frenzy. The World Cup travelers didn't come in the mass that were supposed to, and it's one of their worst low seasons in many, many years. And so I think you're going to experience that in some markets also, where the World Cup actually potentially has a net negative impact, given what it was supposed to do, and then again your normalized travelers during that time frame kind of gearing off and staying away. So we'll see. It'll be interesting, but demand strong, ADR strong, even in light and in the face of insane headwinds. When you think about the war in Iran, gas prices, inflation, low GDP growth at 1.6% projected for the year, and still strong RevPAR. RevPAR and GDP are no longer aligned, and it's kind of interesting to watch in real time.
Yeah, it's kind of the reverse decoupling, right? We had a decoupling, and then now we have a exceeding the economic in terms of the hospitality side. I agree on group. I think group is a huge component of what's going on in the market today. Certainly corporate transient, but I would also say, and this was what we were hoping to see, and obviously you see this in Ryan's numbers, Evan, is a broadening of that demand, right? So when we think about leisure, it was all about luxury, it was all about 4 and 5 star, and it was all about high net worth. And I think we're going back into the pattern this summer, where Americans view vacation as a right, not a privilege. So they're going to take one, right? So that impacts more that middle market, where people are just like, I'm going. And, to Matt's point, there's less outbound because of the noise in the world. And then we have incrementally, we have some inbound, right? Whether or not we want to think about, where I went to the match yesterday in Dallas, it was a zoo, right? It is like a massive stadium filled with Brits and Croats, and both domestic and foreign. And I think you're going to see, so I think there'll be some increment. And again, as we get into the later rounds, I think people just, late booking. And lastly, I would say, the supply point that Matt raised is a huge point. We are just not building hotels anywhere near historical pace. And so if you're not opening new hotels and you've got rising demand, you're going to have that benefit of that 3, 4, whatever the number ends up being for the year RevPAR gain, which is a shocker relative to what we all expected in December, January, right? So I think overall, the fundamentals are good. Now we have cost issues, we have labor issues, we got a lot of stuff to worry about. But when the top line moves, it certainly helps. And at some point we'll get in transaction volume, and I think it's actually probably more muted than it should be, but it's certainly picking up.
So let's before I want to unpack margins and what's falling to the bottom line, but one more, because Matt, you mentioned your occupancy is growing. You look at the industry occupancy, 63%, basically flat for 4 years, and it's still a few points shy of where it was pre-COVID. How do you guys make sense of this demand bump that we're seeing? We talked about the constrained supply. Occupancy looks like it's set to build this year. And if you go back over the last 10 to 15 years, it feels like there was a lot of talk about the lodging cycle and where we are in the lodging cycle. Like, what's your sense for, what's happening in where we are in this cycle? It's been kind of confusing because it feels like the recovery snapped back and then it kind of stalled out, and now there's this reacceleration. Like, is this just getting back to a normalized level of RevPAR growth, or this is going to be like, oh great, we have to lap this in 27, and you lose these event tailwinds, you lose the American 250, the holiday calendar is not as favorable, and we're like back to this, fighting for RevPAR growth, or does your crystal ball say, something changed for the better and we're going to get back into this 3-ish% RevPAR zone, which could persist for a number of years with occupancy going the right direction and helping pricing power? How do you guys, what are your crystal balls telling you?
Yeah, I mean,
a long question.
That was a long question, but I think we could probably chunk that. I mean, I think, I'll go first, but if no one minds. But like history tells you, hospitality is a growth business, and you zoom out, and those RevPARs are real. And the consumer, I think Dan's point on leisure travel, that consumer is very strong, and then you mix in the group, and I totally agree on the convention center pace across the country. Again, it can be a bit hard to paint our business with a broad brush because it's very market by market, but that pace is really strong. So the group is really strong. And then I think there's probably the corporate BT has been good. I think there's probably some gas left in the tank on that if we can quiet some of the macro and geopolitical issues that we've had. And so I do think that we're primed for growth, just like we have been if you zoom out. And I think you're probably also, I'm a little biased just to our portfolio, which skews, more luxury lifestyle and more kind of higher quality, kind of in the upper upscale segments, which just brings us more pricing power. And so we're probably a little skewed to that. Dan and Evan may see a little broader brush, but I think it's just a combination of all the segments are pretty strong.
I think if you look at, I think the broadening of the demand story and the pricing story is most of the number. Group strong, corporate transient strong, et cetera. But you got to remember, like, we've had a couple really good years in the 4 and 5 star space, and then everything else was negative. And if we just got back to break even in mid-scale and economy, the overall number grows, right? And then now we have growth in those segments. Again, I think sort of pent up and just sort of like, damn it, I'm taking a vacation this year, right? I think that is really that's the incremental difference, because I think if we were to isolate, as an example, Matt's portfolio, right? They perform pretty well. I would say they perform pretty well relative to the national averages, right? And the national averages were really held down by softness in the economy and mid-scale segments, and I think that's drifting away, at least for the moment.
So what's falling to the bottom line? Like, obviously 25 was a tough year. I think pretty safe to say margins were down for most people. What's the story here in 26? Obviously, RevPAR is better, but talk to us about what you're seeing in costs and what's actually falling.
Yeah. So it's actually interesting. Our EBITDA growth for LARC for 2025 was negative 4.2%. And for 2026, it's positive 5.4, but then negative again in 27. So it's negative 3 out of the next 4 years, not including 26. I personally think that it's going to be really hard in many markets. I think it's a market by market, right? It's interesting. Let me go back to your prior question, Vince, about RevPAR. I think what we all know at this point is that we have no idea, right? I think we're all like humble and smart enough to know that we have no freaking clue, because I think 25 is expected to be like a 4 or 5% RevPAR growth year, ended up being a 0.5 point, right? This year was supposed to be a 0.5 point. It's going to be probably 3 to 5, right? We don't know. And so I'm confident that we don't know anything. Okay, I'm definitely confident in that.
Matt knew.
Well, Matt's a lot smarter than I am. Like that's why he's on the ownership side. I'm just a dumb advisor over here. So I think EBITDA is going to be really hard to grow. It's actually interesting. And Dan, correct me if I'm wrong on this, but a lot of the broker books we're seeing today are actually having a lot more incremental and sort of slower growth to NOI going forward on a non-capex, story deal, because you look at property taxes. Property taxes are expected to grow over 5% through 2030 on a CAGR basis. Okay, you look at insurance. Insurance is expected to remain elevated, maybe not grow at an elevated level, but remain elevated, which has gone up in many markets 20, 30, 40, even more percent since 2020. Since 2020, and frankly, some markets you can't even get insurance, right? Certain areas in Florida, I mean, Dan, you live in Tampa, right? I mean, part of the time, your home insurance is probably, insane numbers,
right.
Tens
Although
tens
it's come down.
Right, but still tens of thousands of
across
dollars.
Florida, it's come down, yeah.
Yeah. And so when you look at all cost of goods sold, not even talking about labor yet, and in union labor markets, you're entirely screwed because you're totally at the mercy of whatever that municipality or whatever that municipality's union decides to negotiate into the deal, because the owners seem to have very little power to push back against it, unfortunately. And that ultimately, like, for instance, when they passed the new union rules in New York, our first calls obviously were to the large union operators, but then our second calls were to the large non-union operators saying, hey, given that there's a 6.5% CAGR plus to healthcare plus all this stuff, and so obviously going to be a lot of noise to your employees, what are you planning to do? And we got a bunch of different responses from different companies. Some of them were more qualitative, like listen and then respond. Others were more like, we're going to keep pace with that 5.5 to 6.5% growth rate, right? So I don't know. You look at a place like New York, like unless you have 5-6% RevPAR growth over the next 8 years on an average annual basis, compounded, how are you keeping pace with the expense side? So I think, and obviously that's but that's a specific story. I think that happens across the country. I think labor is a continued issue, both scarcity. Now we have the whole technology piece that I'm not going to get into. I'm sure that's probably later in the questions that can reduce expenses. I mean, listen, I've been saying this for years. Your average pick at Marriott, Hilton, Hyatt, IHG select serve asset that has, call it 18 to 22 FTEs. I think in a decade or even 5 years, that hotel should have half, should have between 10 and 12. That'll create other issues in the economy, and that's fine. But those hotels will not be able to keep up with the cost if they maintain the same or relatively the same headcount. Has been my sort of thesis. And so the only way to maintain that 28 to 36% NOI margin is going to take your headcount down, from 20 to 12 or 14 or whatever that magic number is, because those 12 or 14 people are going to be making $20 an hour in not too long. And I'm not talking about suburbs of New York. I'm talking about the suburbs in Kentucky, Ohio, and New Mexico.
Yeah, because we've had to pivot on wages.
I love Ohio.
Dramatically to be able to employ people. When you think about Amazon and you think about all the e-commerce, you think about all the jobs that have been created in different sectors that pay more for the same people, right? I mean, we have been historically a low wage sector, and we have to pivot to maintain staffing until such time as the technology, to Evan's point.
So to your point, Dan, you can't keep RevPAR is not going to keep pace with those increases. That to your point, to keep them at, I don't want to use terms like livable wage, but to keep them at quality wages, you're not going to be able to keep pace because your RevPAR is not going to cooperate.
It's not so much about living; it's about competition, right? So the ability to pay an hourly wage that allows you to employ, decent team members.
So are we taking a victory lap on this RevPAR, or is it just overshadowed because, this is kind of like where it should be, and even with this RevPAR boost, at the end of the day, margin really isn't growing that much in 26, or how do you frame up the relationship here in 26, top versus bottom line?
Go ahead, Evan. I feel like you have the best handle on that.
But the relationship, I mean, listen, I think the bottom line.
Yeah, like you see ADR where it is, but then you
Yeah.
consider inflation. It's like, are margins still flat? Or
I think that 26 is benefiting from cost flexing in 24 and 25, right? I think it's benefiting from some cuts in headcount, some implementation of technology, whether it's revenue management, accounting, being able to be more, I'll call outsourced or global sourced to the home network, if you will, and a few fewer employees. Listen, to single out a brand, you walk into a Citizen M, there's one person at the front desk and 6 kiosks. I can't imagine that in 3 to 5 years from now, that's not every select and limited service hotel where is going to have one front desk person instead of 2 or 3. And frankly, most full service hotels should have the same thing. Luxury is different. Luxury will continue to pay for, good afternoon, Mr. Weiss. Thank you so much for coming. Mr. Siepel, this is excellent to see you for the 3rd time this year. We know you like your down pillows, blah, 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 because a guy like Vince can afford to pay $1,200 a night, right? Very wealthy. It's great.
I hope so.
Yeah. But the point is that if you can pay $1,200 or $800, whatever that number is in your market where you want to go, you'll still have people. But if you're paying $129 a night, like I did on the beach over this week, during the week at a hotel on the beach, right? Guess what? There shouldn't be 3 people sitting at the front desk, 2 people opening the door for me. I could open my own door or make the thing automatic, no joke, and you could eliminate 4 FTEs right away. And that's going to happen. And by the way, it's going to even be a better experience for the guest, because even people like me who are completely technology challenged, you can't even speak, technologically challenged, we want that, because I want a super easy kiosk. And so, again, my point is, I think that the bottom line right now is benefiting from a focus on cost post 2020, post COVID. And next year, I think to your point, Vince, that's when your RevPAR growth, which will probably decline a little bit, sort of coincides with the increase in cost and labor costs and tax, et cetera. And so it sort of evens itself out to plus or minus 1% either direction. And then in order to supercharge that going forward, you can't rely on RevPAR. You can't rely on revenue, especially now with technology and AI. If you think about it, revenue management is becoming a true science more than an art. And obviously there's art involved, and there'll always be someone overseeing it to ensure that the art is inflected in there. But ultimately, it's becoming science more and more. And so, if you're the Hyatt Place, how are you beating the Hilton Garden Inn or the Courtyard or the Express even in your market? You're really not. You're all going to be within a bandwidth unless one of them is of so much better quality. And so, therefore, you can't. There's only so much you can do in that commoditized product space in terms of raising your revenue. So, not enough management companies, in my view, focus on the bottom line, focus on the expense side. And there's going to be a lot more focus on the expense side, both through technology, but also through just a focus on the EBITDA side.
So
I think if you look at like the technological advantages and the other aspects of travel and the other aspects of our daily lives, or e-commerce, et cetera, right? We've always been behind the 8 ball.
No doubt.
Always
Awful.
been behind the curve.
Awful.
And so now all of a sudden, that investment's being made in tech that does make it easier, right? Where you can check in on your phone, your keys on your phone, right? You can, and then the technology behind there in terms of managing up. Remember we got like waylaid by Expedia, like right after 9/11, we got like murdered by all of the OTAs. And then now we're finally to the point where there's still have issues, but there's more transparency, there's more pricing power. And so, but that took 20 years.
Right.
So thinking about that translation between top and the bottom line and who's more focused on the top versus the bottom, like hot button topic these days in the industry is this Marriott credit card deal. And, there's been a letter sent to Marriott, just kind of looking for a little bit more transparency around, the loyalty program, the economics of it, and how it flows to brands versus benefiting owners. Do you guys have any thoughts on this subject, and think that there can be a better resolution? Obviously, it's an opaque area, and the only way something's going to happen is if owners say something, which they have. Hard to know where it will go from here, but just any thoughts on the matter as loyalty has changed over the years, and what a credit card means versus.
Yeah, I think broadly speaking, and I'm going to let the experts talk about this, but broadly speaking, we have, they've gone from, they own very few hotels. They manage less hotels than they used to. It's about owning the customer and the channel, right? And so the credit card is a big piece of that. And so, but it reminds me of, back in the days purchasing, right? You think about Woodley Road and and which was the seminal case, right? In terms of, lack of transparency in purchasing and all the kickbacks that the brand companies got. The brand companies are all going to look out for themselves, right? They get paid off the top line. We get paid more off the top line. Our EBITDA multiple goes up, and, then our company's more valuable. So that is the challenge, is sort of figuring out, okay, where does that meet, right?
Yeah. There's a lot there, Vince, as you know, and it can be thorny if you keep going down the road. But no doubt to owners, it does feel like and has felt like it for a while that the pendulum has swung in the brand's favor in a big way relative to value creation at the ownership and real estate level versus value creation of all of the other businesses that rely on the fundamental real estate. And, you can look at any chart you want, and it kind of shows that pretty clearly. And so I do think there's just lots of different frontiers for this fight to take place. And fight may be the wrong word for it, but at least conversation that the ownership groups, we're giving you all our best stuff, and you're just kind of, just feels like it's a bit of a take at times. And so I think the credit card is a very fair new kind of frontier, if you will, to get a voice, and it's so profitable, and effectively all the expense, which is just them trading in the points, gets passed on to the hotel ownership. So I think if you contrast this back to try to create margin, right? There's lots of ways to create margin. We just need better flow through, and where that comes from. Sometimes we don't even think about that as it kind of comes off the top of revenue, or if you book through the OTAs, you're not even realizing that 20 points you're kind of leaving on the board. I think this will be a very focused conversation, and the brands need a healthy ecosystem. They can't have the real estate struggling. They struggle too bad, the brands will suffer as well. So I think this is only going to kind of stay at the forefront of the conversation as we hunt for margin, trying to make these deals worthwhile investments and reinvestment into the assets.
Yep.
I don't want to pick on the brands because they're clients, they're friends, they run our industry, right? That being said, I think this is sort of echoing what Matt and Dan were saying. The brands aren't hotel companies. To me, they're marketing and distribution companies. And instead of widgets or cars or books, they market and distribute hotel rooms. But they're not hotel companies. Marriott has over 10,000 rooms. What do they manage? 10,000 hotels, 1.7 million rooms. What do they manage? 600, 700 hotels, all full service and luxury. So that's 9,300 of their hotels or more are franchise. And so again, what's their business? It's licensing and marketing. I feel like when I started in this business 20 plus years ago, you looked at the franchise, the royalty and all the pass-throughs and everything, the frequent guest fees, you're probably somewhere around 10, 11, 12 all in. Today, that number is 13 to 15, in some cases 16% of revenue, right? We're talking about margins on a good day for a select serve of 35. That's if you have $120+ RevPAR and you're super efficient and you're in a non-union type market, right? So you start doing some math and you're like, this doesn't make sense. And listen, you also think about the labor side. When you have the brands negotiating a labor agreement, it's like, what are you doing in the room? Like, you have no skin in this game. Every hotel that you're negotiating, even if you manage it, you care about one thing, uptime, and you care about continuity of open time. You don't really care about the bottom line, because if your owner is making 20 instead of 23% because of whatever you just negotiated, your fee is generally off the top line. You'll talk about incentive management fees, but go look at what percentage of their EBITDA and the publicly traded companies there is. I mean, just look at how the REITs trade versus over the last decade, over the last 6 years versus how the C Corps trade. I mean, this has been talked about a million times. C Corps trade at what, 2 or 3 times, it's like a 14 versus a 28 or whatever the numbers are. Vince, you would know the answers to that better than I for sure, but they're substantially different, right? And so ultimately, better alignment is necessary. To Matt's point, if the owners can't make money, they're going to rebel in many ways, whether it's going non-branded, creating their own co-ops of sorts, or frankly, figuring out with technology who really owns your customer, right? You can't stay at a Marriott if there's no Marriott in your market, or a Hilton or a Hyatt or an IHG or a Wyndham or a Choice, and not to pick on any specific brand. Ultimately, the brands will have to realign, especially in the day of technology and AI. I was talking to one significant owner in our space who will remain nameless, and they believe in the next 3-4 years, there'll be sort of a massive come to Jesus moment, a massive sort of shift, and that the brands really need to be ready for it. I mean, we haven't even talked about CapEx, right? Which is sort of a similar conversation about overall. We're talking about, dollars and cents on top line, bottom line, but we're really talking about ROI and return on investment of our asset class of lodging versus other asset classes, or within real estate or outside of real estate. And so if lodging continues to be volatile and dynamic in a way, and it becomes harder and harder to operate and harder to make real money because of whatever other constituencies that we're relying upon, there are going to be less investment dollars, and that'll reduce value because that'll reduce buyer pool. And what's going to happen then? It'll just reduce overall hotel count in some ways, right? I think, you can't keep raising rates in order to keep pace with expenses, because ultimately there is a ceiling, because, we have to stop thinking about America in terms of the coast. There's about 250 million people that live in the middle that travel, and that are the lifeblood of this country, and certainly of travel and of lodging. And the road warriors, truly, right? And if they're not going to pay above a certain amount, they'll just do night trips. And especially as technology increases, like, you're going to be able to go to London for 1 night instead of 3, right? With getting there in 4 hours or whatever it may be, or 2 hours or whatever that number is. So ultimately, I think the brands really should kind of take a step back before an existential crisis does in fact exist between them and ownership and management. I think that's something that's brewing. And the fact that there was a letter signed by 51 owners that own over 1,000 Marriott hotels, and they obviously in some capacity went to the Wall Street Journal, that is the beginning of a crisis of some sort. They would never have done that a decade ago.
I mean, besides complaining about it and asking Marriott to be more reasonable, like, what recourse do owners have besides, like, all right, then we're not going to add as many of your products going forward? Like, I mean, Marriott's kind of unilaterally in charge of setting that, how the program economics are distributed, and they don't have to be that transparent about it. I'm not sure that there's a bunch of brands that actually even are. So I just don't know what, I understand the owner's argument, and it seems like the only check on Marriott every year, just like taking a little bit more of the pie of economics every year, is owners saying something. So owners inherently have to say something, or it's just going to keep happening. But I don't, besides saying something and hoping that Marriott in good faith, is willing to work with owners a little bit more out of fear that it disrupts NUG on a go-forward basis, I don't know what other recourse that owners really have here.
I mean, the truth is, what is true NUG at this point, right? I mean, that's a real question, because there's a lot of conversions happening, a lot of brand switching. The truth of the matter is, like we talked about, Dan mentioned this earlier, there was a 20, 30 year 2+% average supply growth. That supply growth is closer to the next 5-year CAGR of like 0.7, I want to say, 0.6. Start thinking about that. It's like, well, okay. And then also, if I have 3 Marriotts in a market, I want to build a new hotel, let's say, right? Why not just go independent? Those revenue managers are mine. Those sales and marketing people are mine. And so, hey, once that X brand, will remain nameless, fills up, why don't we put them in, the new Matt Hotel over there, right?
I think that's right on. And that is what That's maybe like the most effective tool. To your point, Vince, it's tough if you're existing franchise, you only have so many options, but does that pendulum swing hard, especially for the really high quality stuff? And then does that slowly erode the kind of loyalty points, and you rack up those 250 million people rack up all those points to go stay at the really great hotels. If they stop putting those into the system as a way to start rebelling and just a move because it's easier to access that customer, and then you contrast that with the lack of new supply, which I think is very real. That's the erosion a little bit of that value proposition, and I think that's like the first tool of how you would see major owners fighting back.
Yeah, and you look at all the headwinds on that side, right? The cost to construct.
Yeah.
The environmental, governmental, right? All of the ankle biters that slow down that process. And then if you've got margin erosion on top of it, it's like, why would I build? And so again, we're back to the last 20 years. I think the only 5-star hotel in the country that was built without resi was Four Seasons Disney,
right? Which
was a unique asset of real scale. Nobody builds 444 room, Four Seasons, right? And it was in a super unique location. Well, there's not that's a one of one, right? So now you have all these ones, and now there's headwinds on. You think about where interest rates are, and how much people can pay for a condo in a hotel building in an urban location. And it's just like that special product that gets them the benefit is just not going to be delivered. Now, flip side is aggressively pursuing conversion, but it won't keep up.
I'll tell you what, on the conversion side and on the renovation side, I just went over a property with a couple of my colleagues here. We see a lot, right? We do like 1,500 to 1,700 projects a year, right? So we just have a lot of data and information. And this was a $70,000 a key, 1984 construction, almost 400 room asset that was going from I'll call second tier full service to first tier full service, right? And I was like, holy shit, $70,000 a key. That is a monster. It's a $27 million investment, practically. And I don't, they're doing it,
and what
right?
Do you get?
What are you getting for it, right? Like, are you getting key money for that? Because we've started to see key money on some renovations. Definitely seen key money on conversions. The brands are paying up because there's not a lot of new construction, to Dan and Matt's point. And so, at some point you're like, you know what, the 70,000, a lot of that's brand oriented. It's not qualitative. It's not guest oriented. If I put in 40 and I took 10 more and invested it into distribution technology or whatever that may be, I don't know what happens. We started doing highest and best brand use analysis for one of our special servicing clients. Whenever they're about taking an asset back into REO, they're like, hey, what's the highest and best brand use? And oftentimes it is not staying at that first tier full service brand level, because that 70 to 100,000 a key renovation, there just isn't the ROI, right? Because again, the market's still going to dictate that you can't get above a $150, $200 RevPAR, and therefore you're better off going to tier 2 or tier 3, right? Go soft, go something where there's less, there's less of a fee on food and beverage or ancillary, whatever it may be. So we're seeing that. I'm not convinced that there isn't going to be something of substance that occurs in the next 5 to 10 years.
Mm-hmm.
On the conversion side, you look at the numbers, conversion versus new build. In the U.S., we used to open about 10,000 rooms a month. Now that's closer to 6,000. So you're looking at 75,000 rooms a year. You got conversions, which I think are about 35,000 rooms a year the last few years. And a lot of those have been kind of at the lower end of the market, call it the middle of the market, mid-scale-ish, upscale. Like, at some point, what's been supporting NUG for these brands is conversion. It's kind of 40%, I think, ish of their NUG. At some point, do you reach kind of like this, hey, we've knocked off a lot of the low-hanging fruit in conversions and it gets harder and harder? Or is there just like a massive base from which conversions can churn out each year? Is it like 30,000 rooms on its way to 40 to 50 in years ahead, or are these like, when we look back 5 years from now, this was kind of like peak conversion?
I don't know, but there's so many hotels out there. It feels endless at times, but it's a good question. Should put Evan and his team on it.
I mean, I think. Go ahead.
Go ahead. No, go. Yeah.
I was just going to say, what we've seen, and again, I don't want to single out brands, but what we've seen is that a lot of the brands, like extended stay hotels on the higher end, like upper upscale, like a Residence, Hyatt House, Homewood, stuff like that, that in the past they would have said, okay, that's a Gen 1, Gen 2, we're done. Those are expiring, Gen 3, whatever. Now they're renewing, right? Now they're requiring a lot of CapEx, and the owner's doing it in some of those cases, but they're renewing a lot more, and they've created all these down conversion brands to keep them in the system. The question really becomes, will those down conversion brands perform? They're too new, like a Spark or like a City Express or a Hyatt, Select or whatever the hell they're doing now, right? Do those perform? I think we're 2 years away from having full, ramped data to know that. What I'm hearing is not so much, not at the levels that they thought they would. So it's interesting, but yeah, it's going to be an interesting sort of tracking over the next several years.
Yep. Yeah, I mean, I think at the end of the day, they've been able to feed the machine through M&A and launching of these, downscale brands, where they could take a product that's done and kind of find a place to keep it in the system. So I think that helps a lot. How much can you do that? I don't know. I mean, look, I said this on a call the other day. I've been saying it for a long time. I'm not the first one to say it. I mean, we are, we're not overbuilt. We're under demolished. We have a lot of lousy hotels as a sector, and those need to be addressed in some fashion. And I think that the acute challenges we have relative to workforce housing and low income housing and certain markets, even like students and things like that, certainly not in the broader apartment business, but I think that's gonna be a bit of a siphon, right? It's gonna suck some stuff off, and plus you also remember when you go into that business, you plug into an entirely different capital market, which is more profitable. Period. And so it's going to be an interesting dynamic, and can they keep up with M&A and brand creation that allows to keep that machine flowing without dumbing down the brand, right? That, there's some of the product is not what, like a traditional Marriott or Hilton or, Hyatt customer might think is out there. But again, if you spend the right capital and you kind of create that lifestyle experience, I think you can continue the growth.
So I was looking at some numbers. I mean, just to hit on something earlier, Spark, I think, is about 10,000 of those 30 to 35,000 rooms that convert each year in the U.S. So I mean, it's resonating. Time will tell on the performance, but it's clearly fitting a need for owners. But then, I wanted to get your guys' take, and I think it's relevant to the conversation here. You think about like brands for brands, and you see Marriott just signed a 12, hotel multi-unit conversion deal yesterday for a portfolio to join their Marriott Design Hotels. You have Scripted by Hyatt. You have Select by Hilton. What's your sense for kind of this new era or new niche in the market?
Seems like they're reaching. I mean, if you think about it, they're no longer acquiring these brands. And I think that's on both sides. I think the brands don't want to be acquired to an extent, but they're not getting the multiple that they want. They'd rather affiliate and juice revenue. And then for the brands, for the Marriott, Hilton, Hyatts of the world, it's a home run for them, right? They just slot in another, brand. Now it's Pally House or whatever it may be, and they can just sell more into the network and more for the frequent guest program and all that. So it's pretty low cost and low lift on a relative basis, of course, for the major brands, and for these smaller, more fledgling or rising brands, they see the value in it. And I think Marriott or Hilton, Hyatt, IHG, et cetera, just may not be willing to pay for those types of brands right now. So will it be successful? I don't know. In some cases, it certainly seems like it is bastardizing a lot of the existing, right? I mean, you take a look at a few of the major brands and the sub brands that they've acquired and or affiliated with over the last 3 years or so, and there's a lot of overlap, and it's confusing for the customer, it's frustrating for the franchisees, and it most definitely reduces their overall revenue and their overall viability. So,
got it. As we're wrapping up here, Dan, I'd love to get your take here. Like, you think about the tone at Alice and then Hunter and then NYU, just around deals and, where the bid ask spread is and kind of the optimism or lack thereof in the industry. How would you kind of characterize the evolution through the course of this year, and what are you thinking for deal flow going into the second half?
Yeah, it's definitely slowed. We saw I think coming out of Alice, the people have ignored the whole historical timing of, I got to have my deal in the market at NYU, I got to have my deal in the market at Alice. So like at Alice, we saw a lot of deals come out after the fact. You think about, Strategic and Braemar and a bunch of stuff our team was working on, et cetera. Like, you just look across the board, there was a lot of larger product. And we started to see that in Q4 last year, where when rates came down, when spreads compressed, where the equity got a little bit more acquisitive, bigger deals came to market. We're in a bit of a lull right now, right? You had Braemar pull some stuff back from the market. They're now a new REIT, whatever they are. Strategic is in the process of pricing some of their stuff. We just, transacted a few larger deals in the last few weeks. And, I would say combination of the right deal in the right market, a constructive debt market, and equity that has been sitting around for a while waiting to do things. And so I think that has picked up. So I think overall we'll see volume will be up, but it's going to be a little bit hit or miss. There's always liquidity in the small deal space. So that remains to be the case right now, where you can borrow at the bank level and the credit union level and CMBS level, et cetera. And then when you get in the bigger deals that have gotten done, SASB market's been highly cooperative. The spreads have tightened substantially and rates came in. I mean, right now, I think what we're worried about is what's the condition of the economy relative to all the global noise. And what is the Fed going to do? Obviously, yesterday they said nothing, but if rates are going to move back up, that is a headwind. So I would say overall, it's a fairly constructive market. There's probably less product than there is demand for investment, and we can see that in like the number of bids, right? So you see deals that used to get 5 bids now got 10, they got 10, they got 15. So there's people definitely engaging and trying to get things done. And again, it's sort of it's like, okay, big group urban, because we like the dynamic there. High barrier leisure, like the dynamic there. But then you shift, and those are those assets probably price 100 basis points inside the generic full service hotel. And then you take into the fact that there's a lot of things that aren't trading because of Evan's point, which is 75 to 100,000 a key PIP for a 40-year-old box. It's like, that's going to have to price at a very high, going in yield in order to get somebody off the sidelines to do it. And then obviously you get the markets like LA right now, which is still remain to be kind of a very challenged market. Historically LA would be a big part of transaction volume. San Francisco's come back, and that's nice to see, not scale, but certainly has come back. But some of these big markets, New York kind of froze while we waited for the union deal. Now we know what we have, so people will figure out where they want to transact. But yeah, I would say overall, higher RevPAR is good. Better lending market's good. Certainly lots of equity in the world, but there's obviously a lot of demands on the equity, right? When you think about, like one of our big challenges up until recently was private credit, right? I mean, it was on a risk-adjusted basis. A lot of the big players are like, I'd rather have 75 cents than 100 and get my, low to mid-teens levered return. It's hard to compete with that. It's really hard to compete with that.
Yep.
Matt?
Evan, anything to add to that?
Yeah,
I mean, that was a helpful overview.
Yeah, I like all that and kind of totally agree. Obviously, we work with Dan and his team a lot. I'll maybe throw something out there, get your opinion on it, Dan, because the financing markets have been so strong, and the lenders and spreads have come in. They're aggressive. You have some new. The private credit market is still there, aggressive. Just aggressive all over. But the values haven't, come up. And so typically that's the kind of the grease to this machine, right? Is these the good debt markets. Okay, great. We can put that in our model and underwrite that. You start to throw in these deals that, okay, I can go sell at, if it needs some CapEx, to your point, Dan, I could sell it at 8.5, 9, maybe north, or I could just refi it at 10, 10.5, not trigger my change of ownership PIP. And I take 50 cents, my dollar off the table, but I get done the taxes. I get another bite at the apple, and I don't have to go into my committee and say, it's over. We're still fighting the fight, and we return some capital to investors and keep growing out of this. And so it's almost like I
completely agree.
Yeah, okay. It's an interesting trend that we're seeing.
And refinancing, for sure is competition for sales. I mean, thankfully we are in the financing business as well.
Yeah.
But financing was absolutely and remains competition for sale. You're gonna, you have that deal that's 100 basis points inside market, and it's a little long in the tooth, and it's time to transact, and then you get a great trade. Or people are thinking about, well, maybe I should refinance this.
Correct.
Maybe I should, to your point, live to fight another day.
I mean, I fully concur with all that. I used to say on our internal calls, I used to say that the market is busy 40 and under 40 and above 140, right? That was sort of I've now expanded that to sub 30 and under and above 150. Because you think about the transactions we're seeing, and you guys mentioned Braemar and Strategic, you look at what we're seeing generally in the market, Crystal Springs, $235 million in New Jersey, 176 Park Hyatt, Beaver Creek, right? Ritz Sarasota, Yountville, and Bartostono under contract for 437, over $1 million a key on average, whatever that means on an allocated basis, but it's probably roughly that, but 437 million for 3 assets, over 100 million each. These are the types of transactions that are getting done. I think equity's there, but equity's hard. I think equity's more demanding than it's been in a very long time. And because of that, they're looking, if they're going to work hard, they're going to say, I want to put out a $50 to $100+ million check. I don't want to write a $20 million check or even the 30 or 40. And so we're seeing the sub 30 stuff because you got a bunch of guys that can get together and say, hey, each one of us puts in 2 to 5 million each, and we can go buy a $20, $30 million asset. And so you're seeing those transactions happen a lot more frequently. There's no investor committee. They're passing the hat. They can afford the hard deposit or the soft deposit for sure. The bigger stuff is like, whoa, we got to go through committee and all this stuff, and then it doesn't happen unless it's big. And so that's not to say there are no transactions in 30 to 150. That's obviously not what I'm saying, but I'm saying generally speaking, the commoditized stuff in that space is really hard to move. I also think it's like, to your point, the financing markets there's a ton of debt providers. They're pretty tight. I mean, we saw a non-bank private equity style lender quote 295 over SOFR. On a portfolio transaction. And I was like, holy crap. I'm like, am I seeing what I'm seeing? And I actually called the lender and I said, hey, is this factual? She's like, yeah, that's, we had to get tight, and we did. And I was surprised. I hadn't seen a sub 300 spread, on select serve portfolio transaction in a very long time. And so lots of lenders competing for the business that's out there. Our valuation business is busier than ever on a volume basis, which is a good thing, which means that there's a lot of things happening, probably 80-20, 90-10 refi versus transaction for sure. And yes, I think the debt yield business is way better than the cap rate business right now, right? In terms of value versus on transaction versus value on let's be candid, on a refi. And the execution is far more accretive unless you're at the end of a fund life or major capex event. The execution is far more accretive to the borrower and to the owner. And the other thing, you think about it, right? Guys like Matt and his firm were probably buying select service in 17, 18, 19, somewhere between a 6.5 and a 7.5, all in post capex. Great stuff 6.5, average stuff 7.5 for that brand new 3-year-old home too. that transaction today is going off at an 8.5 to a 9 post CapEx all in, even if it's 5 years old, right?
Yep.
So if you're that owner and you bought at 7.5, you borrowed at 3.5, 4, and you're coming up, and now the transaction market's at a 9 or an 8.5 on a good day, and debt's where it's at, even at the same LTV, you've got significant issues. And we're getting calls every day to see if folks can do cash neutral refis, which in a lot of cases on the smaller sub $50 million stuff is really hard, because all things being equal, RevPAR is fairly, flat, and and expenses are significantly above, and therefore your NOI is, say, the same as it was 5 years ago with these new parameters.
Right.
Yeah.
So, and we as appraisers reflect the market, right? And so it just is what it is, and I think that's creating a lot of disruption, frankly.
Yep. Great.
Good opportunity.
Well said.
We'll
right,
we'll
guys.
leave it there. Out of time, guys. Matt, Dan, Evan, appreciate you joining here this afternoon. Always enjoy what you have to say, and sure I'll see you around at the next conference.
Thanks,
Thank you,
Vince.
Vince.
Thanks, everybody.
everyone. Thanks, Vince.
See ya.
Thank you. This does conclude today's conference. You may disconnect at this time, and have a wonderful day. Thank you for your participation.